Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving the chapter number 10 quiz from the ACCA Study Hub. So this chapter primarily pertains to the cost of different capitals that you have, equity capital. In equity you have ordinary shares, preference shares, debt capital. So all of that is covered in this chapter. So let's get started with the quiz. Side by side, I'm also going to open an Excel so that we are able to solve as well as see the questions together at the same time. All right. Just give me a moment. I hope you're able to see the screen as well as the Excel file. So we have the question over here. This is question number 1. You have to calculate the cost of preference share capital. So HPA company has 8% of 50 cents preference shares in issue with a current market price of 60 cents per share. Corporate tax rate is given. Although you don't really need this information over here, this has just been given to confuse you. You're going to use simply the formula that you've learned to calculate the cost of preference shares, which is nothing but the dividend upon the market price. So we have the dividend rate is given to us as 8% multiplied by the nominal value, which is 50 cents. So this is my dividend, which I pay every year. Now, if I talk about P0, which is the market price, this is also readily given as 0.6. So my answer becomes 0.4, 4 cents divided by 60 cents. So this over here becomes my answer. If I just convert it to percentage, I will have my answer as 6.7%, which makes your answer as option C over here. Let's move ahead. Which of the following sources of finance usually has the lowest cost to the company? So whenever basically the hierarchy in which we have the cost, basically your debt is cheaper than your equity. So all other things which you see over here, retained earnings, preference shares, ordinary shares, these all form a part of your equity. Loan notes are the lowest risk takers. So once you get low risk, people also get compensated with the lower return. So loan notes have the lowest cost. If you talk about retained earnings, they form a part of your ordinary equity, hence the cost is considered to be the same. The cost of retained earnings is basically considered to be having the same cost as your ordinary equity. Then you have preference shares. So preference shares are more costly if you compare than loan notes, because the risk over here gets further more, because firstly loan note holders will be paid, then preference shares will be paid, and then ordinary shareholders will be paid. So according to the hierarchy, the lowest which we have is the loan notes, and hence the cost is also the lowest. So option B over here is your answer. Let's move ahead. Now, question 3 says the capital structure of a company includes 12% $100 loan notes. Investors require a 14% return on loan notes of this level of risk. Corporate tax rate is 30%. What is the company's after tax cost of debt? So this is pretty simple. Basically, the return which is required by the investors, if you take into 1 minus t with that, then you arrive at the cost to company. So 14% multiplied by 1 minus tax rate, which is 30% over here. You hit enter and 9.8% is what you get. This is your answer, that what is the company's after tax cost of debt. So you can say 9.8% is your answer. Moving ahead to question number 4, the shares of Fargo company have a market price of $85 per share. Dividend after 1 year is expected to be 4.25, and it is expected to grow at 7% per annum. You have the corporate tax rate over here as well. So even though this is not something which you need, this is question number 4. The formula which you have learned is D1 divided by P0, which is your present market price, plus the growth rate. So I'm going to use exactly the same thing. D1 is basically the dividend that the company is going to pay after 1 year. So please do not incorporate growth again, because this is the dividend which has been given after 1 year. This itself is D1. This is not D0. So this does not have to be multiplied with 1 plus G. So this is your D1 already. So 4.25. And then you divide this with what? Your the current market price, which is given to be 85, and then you add manually to it your growth rate, which is 7%. So if you hit enter, you're going to get your answer as 12%, which makes your option C the correct answer. Let's move ahead to the last question now. A company has 80% payout ratio. Expected return on its projects is 15%. Company's market cap is given to be $1.5 million, and the most recent profit after tax was 125,000. So over here, you can see that because the payout ratio has been given to us, you will, to calculate the growth rate, you are essentially going to use the G is equals to BR method. So basically, B is your retention ratio. If 80% is payout, that means 20% your company is retaining. Multiply that by the expected return, which is 15%. So over here, this is question number 5. Let's first work out G. G is going to be equal to, firstly, take 20%. 1 minus 80 is 20%. So 20% multiplied by 15%. This over here, 3% is your growth rate. Now you have your growth rate, you want to find out the dividend now. So the dividend, basically you can find out using, the tax rate is given and payout ratio is given. Payout is nothing but the dividend that a company is paying. So dividend is equal to 125,000 multiplied by 80%. So 100,000 is what the company is paying as the dividend. And then you have the market price. Basically, market capitalization means the number of shares multiplied by the market price per share. So because we are working in absolute terms, not in per share terms, we are going to take 1.5 million itself. Right, so this is 1.5 million over here. Now let us apply simply the formula to calculate the cost of equity. So the cost of equity is, firstly you take your D1, this is your dividend, then you multiply this with 1 plus G. So into 1 plus G is right over here. This is your numerator. Then you divide this whole thing by your denominator, which happens to be the share price or the market capitalization in this case, and then you add the growth rate to it, so plus 3%. So with this, you are getting your answer as 9.86, or you can say roughly 9.9%. With this, you mark option B as your answer. Let us submit this, and we are all through with this chapter's quiz. I hope that this video helped you understand probably something which you were stuck with, and I hope that this was useful. If you want me to solve anything else, you can let me know in the comments down below. Thanks for watching.